All right. One Asia expert warns China's explosive rally ignores the risk of a Japanese-like quagmire. Yale senior fellow Stephen Roach is formerly Morgan Stanley Asia's chairman. He wrote a Financial Times op-ed this week titled "Why China Needs a Three Arrows Strategy." Stephen, great to have you with us. You heard Tim reference an Evercore analyst, China strategist, making the comparison to the U.S. fiscal stimulus of 2008. You're actually making the comparison to the lost decade in Japan. Why is that?
Well, thanks, Melissa. And I always hesitate to take on the firepower of the fast money crowd, but I'm still on the skeptical side. I think the China-Japan comparison is simply too close for comfort. Bursting of a major debt-fueled asset bubble, the demographic and productivity challenges, and a whiff of deflation right now, and a growth shock that is very Japanese-like. So I think we have to look at this story from a Japanese-like perspective, and that's the title of my piece, The Three Arrows of Abenomics. And I don't see all three arrows in the air right now, especially on the structural and fiscal side. So again, count me a skeptic.
Right. And just for the audience's sake, the three arrows that you're naming, fiscal, monetary, as well as structural. So you named two of them that you don't think are really robust. Structural in particular, the demographic challenges in China, that's certainly not being addressed in any of the stimulus right now. Guys, got a question.
Mr. Roach, I like that high-powered, fast money crew. That's a first. But I'll ask, I think it's fine to be skeptical of the economy. I agree with you there. But can you be skeptical of the economy but bullish on some of these underlying stocks in their stock market for the foreseeable future? When I say the foreseeable future, to the end of the year.
Sure you can. I mean, we know this was a seriously oversold market, and it's turned around dramatically. But again, I'm going to take you back to the Japan story. The Nikkei 225 fell 66% from December of 1989 through September of 1998. During that extraordinary plunge, probably the biggest plunge in a major asset market we've ever seen, there were four dead cat bounces that averaged 34%. So if you believe in the Japan comparison, you got to be a little wary of what's happening to China if you think China is following the Japan template.
Stephen, we talk about the wealth effect when you have stock market going up, when you have housing going up. When you consider the sort of losses that consumers and investors have in China, in the property market, in the stock market, does this sort of move change anything in that regard as you think about the consumer? Because some of the names that moved first, and they've been relentless, are these consumer-facing businesses, whether it's Alibaba, Meituan, JD, Tencent, that sort of thing. And it just seems to be that this is kind of a beta chase. And if you go back to 21, that's exactly what was happening there. They had a bubble not too different than the one that we had here, and valuations got stretched and the like. So curious about the wealth effect that is or is not created by this sort of stimulus.
Well, for a wealth effect to really have traction for consumers, it's got to be sustained. And, we've had 8 days. I mean, this is not something that I think well-strapped investors really believe is permanent. And if this rally lasts, as you guys think, then it'll start to have an impact. But it's not just wealth that drives consumers. They need income. The job problem in China is tough, especially for younger people, where the youth unemployment rate is high and still rising, no matter how many times they redefine the numbers. So we'll have to wait and see on that. I mean, right now it's encouraging, but far too soon to tell.